Hi, and welcome to another episode of Inside CalSTRS Investments, an opportunity to see how teachers' contributions are invested for the benefit of California educators. I'm here today with Chris Ailman, who's the Chief Investment Officer at CalSTRS. Hi, Chris.
Hey, Mike. Thanks for being here.
Oh, my pleasure. So the fiscal year is over and we're starting a new one, and it's a time to look back on how we did last year and over the long term. So how is the portfolio doing in terms of our long-term performance?
Well, great question, because we're long-term investors. So for us, really we look at the 3, the 5, and even the 20-year return. I always say, as a pension plan, it's a marathon. So 1 year is just a pace per mile. We want to look at our average pace. And over the 3 years, we're doing okay. We were up 7.8%, 5 years about 7.6%, and those are both net of fees. So we're hitting the pace we want, which is 7.5. But obviously, the reality is we realize most of that was from that big first year. The last 2 years have been a heck of a struggle for us, so our pace has been slowing.
So let's talk a little bit about this last year. I guess the watchword was volatility.
Yeah, it was a very difficult year. So for us, the 1 year return was only about 1.4%, so very low, unfortunately. But it looks like that's going to be about median to above a median of other pension plans. So I think we did pretty well on a very, very tough year. And when you look at across the portfolio, we only had one asset class that had a double-digit return. We usually have 2 or 3. Real estate was the one area. But things like global equity really struggled. Non-U.S. equity did not do well. And then at the end of the year, we had the Brexit. So there we are, right almost, at the 1 mile mark or the 1 year mark, and boom, we have a couple of volatile days. It really was difficult to make a return last year. As you said, volatility was the name of the game.
Looking forward, what are you seeing as opportunities?
Well, we think it's going to continue to be a pretty tough market to make a strong return. We think that real estate, longer term investments like real estate, infrastructure, private equity will actually start to show pretty stable returns. The USA is growing, but very slowly. Europe obviously is having to deal with Brexit, and Asia is very slow as well, including China. So we realize that from our equity portfolio, we're probably going to have another low return kind of a year. And not surprising, we think it will be a struggle. But we've seen that when we look back at past decades, look back even to the 1990s, which now looked like a great decade, 91 till about 92, the U.S. had a 1% growth, a very slow, very tough type of stock market, just like we're seeing today. So I think even though we're in this period, and we may be here for now a couple of years, 2 years ago, a 4% return, last year 1.4%. Next year could easily be difficult. It doesn't mean it's going to stay that way forever. I've got to emphasize that very strongly. Just because we're experiencing slow growth now does not mean we're going to see that. You can't bet against the USA and the level of innovation, the level of change that we will see in the next 10 years. And our portfolio is positioned to capture part of that growth and that innovation.
Well, Chris, thanks for your time and insights.
Thank you, Mike. It's always great to talk to the members.
You've been watching Inside CalSTRS Investments. I'm Mike Cecilia. Thanks for watching.